Welcome to the channel and welcome back to another video. On this video, I want to give you guys an overview of what a reverse mortgage is, and I want to give you the pros and the cons. My name is Eric, and I write a blog over at smartmoneybro.com. And on that website, I recently wrote an article about reverse mortgages, what they are, the good, the bad, the ugly, as well as just a general basic overview of what they are, because so many people are confused about reverse mortgages and what they are. And these mortgages have also led to a lot of foreclosures on the homes of older adults. And I think it's really important to get a basic understanding of what they are in case you're approached at some point about getting a reverse mortgage. You want to kind of have a feel or an idea of what they are. If you're stopping by this channel for the first time, I would appreciate it if you subscribe to the channel. And if you get any value out of the video at all, please do me a favor and go ahead and smash the like button for me. So let's jump into it. The first thing I want to tell you about reverse mortgages is this. A reverse mortgage is simply a loan. That's the very first premise you have to understand. It's called a reverse mortgage, but it's actually a loan. So what I'm going to do in this video is I'm going to call it a reverse mortgage loan from here on out. That way there's no issue about exactly what it is. It is a loan. Now, what's the purpose of this loan? The purpose of a reverse mortgage loan is to provide some money for people that have a lot of money in their home, but they don't have a lot of money saved up, a lot of retirement money. So reverse mortgages are there to provide a loan for those folks that don't have any retirement money, don't have very much retirement money, or want some more money to be pulled from their home, but they plan to stay in their home. If you plan to stay in your home and you're over the age of 62, because you have to be 62 to get a reverse mortgage, at least. You can be older, but you got to be typically at least 62. If you're over the age of 62 and you have a lot of equity in your home and you plan to stay in your home, you're eligible for a reverse mortgage loan. And here's why. Because a reverse mortgage is a loan against the equity that you have in your home. So in other words, I'll give you a quick example. If you have a home that you've been paying on for a lot of years, 10, 15, 20 years, and the home is worth, say, $200,000. If the home is worth $200,000 and you only owe $100,000, you have $100,000 of equity in that home. Equity is simply the amount the home is worth minus the amount you owe. Whatever's left is equity. And so in that example, you have a $200,000 home. It's worth $200,000. You only owe $100,000. So $200,000 minus the $100,000 you owe leaves you $100,000 in equity. So a reverse mortgage loan is a loan against that $100,000 of equity. Now, you won't get a reverse mortgage loan against the entire amount of your equity. The bank or the lending institution, they'll give you a reverse mortgage loan on a percentage of your equity. So let's say it's $50,000 that you can get a loan on. Your house is worth $200,000. You've got $100,000 of equity. You can't get a loan on the entire $100,000, but let's just say you get a loan for $50,000. Now I'm making this real simple. We can get into a lot of details here, but I want to make it as simple as possible. You can't get a loan for the entire $100,000 equity, but you can get a loan for a percentage of that equity. And let's say, for simplistic purposes, you can get a $50,000 loan. Now, with a reverse mortgage loan, you can take that $50,000 in one lump sum. You can take the $50,000 in a home equity line of credit. There's several ways you can take that money, but let's just say you take the whole $50,000. Now, that $50,000 in cash as a loan from the mortgage company to you is your money to do whatever you want to do with it. The more equity you have in your home, or if your home is paid off, the more money you'll get in a reverse mortgage loan. So in the same scenario, if you have a $200,000 home and you only owe $50,000, now you have $150,000 of equity and you can get a loan on the $150,000, a percentage of that $150,000. So you might get $75,000 for simplicity purposes. So basically, that loan is to pay you for the remainder of your life, if it lasts that long, and to allow you to stay in your home until you die, until you sell it, or until you move out. So that's the basic general premise of a reverse mortgage, to help people who have equity or who have their home paid off, that are over the age of 62 and want to pay their expenses and don't have a bunch of money in a whole bunch of different accounts, and they don't have a lot of money saved up, but they have this home. It's a way of extracting the cash out of the home value and allowing you to live on that money. That actually talks about some of the pros of a reverse mortgage loan. Now you have a lump of cash that you can use for your monthly living expenses. And at the same time, you get an opportunity to stay put right where you are. One of the positive things about a reverse mortgage loan is that they're what's called non-recourse loans. And a non-recourse loan basically means that the mortgage company or the lender, they cannot come back and get more than the house is worth. If the house is worth $200,000, they can't come back and get $260 from you or $280 from you. They can only get back the amount that the house is worth on the open market at the time of the sale, the time you leave the home, or the time you die. So that's a good thing about reverse mortgages. They're non-recourse loans. And if you're not sure about what I'm saying about them, please feel free to Google a non-recourse loan so you understand that that is a positive. Now, some of the cons and issues with a reverse mortgage loan. One is, with a reverse mortgage loan, there are a lot of fees associated with getting the loan, because just like any other loan, there's closing costs. There's origination fees and filing fees, and there's a lot of fees involved. All of those fees can typically be added to the closing cost of the loan, but you still have to pay them. So in our first scenario, we said you had a $200,000 home. It was worth $200,000. You owe $100,000. Your equity is $100,000. You get a $50,000 loan against that equity. Now you have to, out of that $50,000, you have to pay closing costs for the loan. So you have to pay the origination fees, the filing fees, and all of the fees that are associated to bring that down. So therefore, you got 50. But by the time all the fees are plugged in, you might have 40. You might have 42 or 43. But your loan is decreased by the closing cost. And the closing cost typically includes all the extra fees. So now you're down to $40-something thousand that you have. Let's say $40,000. So now, and these are real basic numbers, but I'm trying to show you how a reverse mortgage can eat away at you, and you end up not having a whole lot. That's a big con, and it's one of the reasons why a lot of people have problems with these reverse mortgages, and they end up foreclosing on their home. So with that said, you've got to pay all your fees out of that $50,000. So now you're down to $40,000. Now, also, one of the things that you need to know about a reverse mortgage loan is that although you've got a loan on the equity and your home is the collateral, you also have to monthly or yearly pay your homeowner's insurance, pay your property tax, and pay any homeowner association fees. Those are more fees you got to pay. So if you happen to have a home where your insurance is $2,000 a year and your property tax is $3,000 a year, that's $5,000 a year plus your homeowner association. Let's say that's $1,000 a year. That's $6,000 a year that you have to pay on while you have this reverse mortgage loan. And so $6,000 a year, that ends up being what, $500 a month. So now you only got $40,000 left after they took all the closing costs and fees from your $50,000. Now every year you have to pay $6,000 for insurance, for property taxes, and for homeowner association fees. So do the math. You got $40,000. If you're paying $6,000 a year, that's taking up all of your money in about almost 6.5, 7 years, all the money that you thought you had to use from this reverse mortgage loan is eaten away by the closing costs and by the insurance and property taxes and HOA fees every single year. So you're only 6 or 7 years in, and the little $50,000 that looked like a lot is gone. So that's how people get in trouble. Older people get in trouble with these reverse mortgages. Now, though these numbers that I'm giving you are very basic numbers for simplicity purposes, but I'm doing it that way so you can really understand how that reverse mortgage loan that you thought was going to take care of you for 10, 20, 30 years, it's not going to take care of you very long because the fees add up quickly. Now, in our scenario, perhaps a $200,000 home that you own won't have that high of property taxes and insurance. Let's say it's only $4,000, but still, $4,000 over the course of 10 years is the $40,000. So basically, you don't have any extra money like you thought you would have. Here's another con, another reason why reverse mortgage loans can hurt people, is because let's say that you're 62 or 65 and you want to do a reverse mortgage, but lo and behold, you get to 70 years old, and as I said before, you want to move to an assisted living facility. Well, you've taken out a reverse mortgage so that if you move out of that home, now that entire loan becomes due. The loan and the mortgage becomes due. So that becomes a problem. If it's not your permanent resident for at least 6 months and 1 day of each year, then now the loan becomes due. So another negative about reverse mortgage loans is the fact that you've taken all 20, 30 years of your life to pay a home down. Now, all of a sudden, you have a new loan. It's providing you money on a regular basis, provided you cash. But when you go to sell or you die or you leave that home to your heirs, now the people that you thought you could have potentially left the property to, now they have to either sell the home or they have to do something with the home, maybe even pay on the home, but the whole mortgage is due if you die. So your heirs who were hoping and thinking maybe we had this piece of asset in our family and it could stay in our family, it's going to be gone or foreclosed on, and the mortgage will be due at the time. So that's another problem. You can't really pass down a lot of generational wealth when you have a reverse mortgage. So in this quick video, I just wanted to give you what reverse mortgages are, what are the pros, what are the cons, what are the things to think about them. You have to get educated on them before you do it, because it's really taken a huge step, and there's a lot of cons and there's a lot of reasons, and it's easy to foreclose on them because of the fees and because you have to keep paying the property taxes and insurance. Now, those things were escrowed into your mortgage, and they just got paid every year by your mortgage company. But when you do a reverse mortgage, those things have to be paid separately by you. You cannot escrow in your property taxes and your insurance and all that stuff when you have a reverse mortgage loan. So I hope this was helpful. I hope it made sense. It's the basics. It's an overview, a really simple example of what a reverse mortgage is and the pros and cons of a reverse mortgage. Again, it's a reverse mortgage loan because it's just a loan against the equity. Again, if you're stopping by this channel for the first time, please consider subscribing. And if you got anything of value out of this quick video, please do me a favor and smash the like button. The best person to take care of the old you, so when you get age 62 and over, you already know what's coming with reverse mortgages. The best person to take care of the old you is the young you. Take care of yourself and take care of other people around you. Until the next video, peace.